Welcome to Global Money Moves. Today we are unpacking why oil back above $100, a closed Strait of Hormuz, and the US-Iran war are smashing markets. And why, despite the fear, markets still haven't completely broken. This video is for educational purposes only, not financial advice. From regional war to global oil shock, the conflict between the US, Israel, and Iran has moved from limited strikes to full-scale confrontation. It now directly targets energy flows. Iran's new supreme leader, Mujtaba Khamenei, has vowed to keep the Strait of Hormuz closed. The strait is the narrow choke point through which roughly a fifth of global oil exports pass. Bloomberg and the IEA report that this has triggered the largest supply disruption in the history of the global oil market. Brent crude has surged back above $100 a barrel, with some analysts warning of even higher prices if the shutdown drags on. Trump says preventing Iran from getting nuclear weapons is more important than the cost of oil, signaling Washington's tolerance for pain. That combination, a choke point and leaders doubling down, is exactly what markets hate. How markets are reacting? Fear, then fast recalculation. The immediate reaction has been risk-off across the world. In India, Nifty 50 has slipped below 23,200 and the Sensex has dropped over 1,400 points as spiking crude raises inflation fears. Market data show heavy foreign institutional selling and a sharp rise in the India VIX, the volatility index. Sector-wise, cyclical indices like IT, realty, and banks have seen drops of 8 to 10% in just the last few trading sessions. In the US, Thursday saw the Dow drop 739 points and the S&P 500 slide toward its third straight losing week. And yet, by Friday morning, US futures were bouncing. Buyers saw an opportunity to pick high-quality names at lower prices. Analysts describe this as a Thursday crash, Friday rebound pattern, driven by AI-driven trading and strong corporate balance sheets. Gold, volatility, and the don't play geopolitics warning. While equities have whipsawed, safe haven assets have done exactly what textbooks predict. Pre-market snapshots show gold and silver bid higher as headlines flash, US-Iran defiant on war, signaling a hedge against crisis. Multiple investment houses are issuing the same warning. Don't play geopolitics with your portfolio. In plain language, that means don't try to day trade war headlines. Don't make big bets purely on your personal view. Focus instead on your time horizon, asset allocation, and the fundamental impact of higher oil, inflation, and slower growth. Geopolitical shocks produce violent dislocations, but markets can also rebound quickly if earnings and policy remain supportive. Why India is feeling the heat and still has cushions? For India, this shock hits through three main channels. 1. Energy and inflation. India imports most of its crude. Brent above $100 raises the import bill and worsens the deficit. Higher fuel prices filter into transport and food costs, forcing the RBI to think hard about interest rates and liquidity. 2. Markets and foreign flows. Foreign investors have sold tens of thousands of crores, contributing to the fall in Nifty. Domestic investors are partly cushioning the blow, but sentiment is clearly risk-off, especially in oil-sensitive sectors. 3. Geopolitics and diplomacy. India is trying to maintain strategic autonomy, buying from Russia, trading with Europe. The longer Hormuz stays shut, the more complex this balancing act becomes. US sanctions on Russia are a critical variable. The US has quietly allowed some Russian cargoes to move to ease price pressure, especially for big buyers like India. The good news? India still has growth momentum, domestic savings, and policy space compared with many economies. But that doesn't make it immune to sustained 100+ oil. We must remain vigilant. How should you, as a viewer, think about all this? A few grounded ideas. Recognize that we are in a new regime. Geopolitical shocks, wars, tariffs, sanctions are now structural features. Separate short-term noise from long-term trends. Short-term, oil spikes hurt. Long-term, supply alliances matter. Focus on resilience, not hero traits. Expert advice is to avoid emotional swings and diversify sensibly. Understand which sectors are structurally sensitive rather than betting on daily headlines. This is about survival and growth. If this helped you connect today's oil shock to the bigger 2026 story, hit like, share it with a friend, and subscribe to Global Money Moves. We bring you clear daily videos on global news and geopolitics. Once again, this is educational content only and not financial advice.